Welcome to This Explainer. Today, we're diving straight into Chapter 2 of the NSIM Research Analyst Workbook. We're going to build a complete, easy-to-understand blueprint of the entire securities market ecosystem. So if you've ever looked at the massive gears of global finance and wondered, how does this actually turn? Well, you're in exactly the right place. All right, let's kick things off with a massive question. How exactly do idle savings fuel global economic growth? Basically, how does the market take stagnant money, just sitting there, and turn it into the actual engine of the global economy? At its core, the whole financial system is just a matchmaker, right? It connects folks who have extra cash with the businesses and governments that desperately need that cash to build, to innovate, and to grow. But, how does that matchmaking actually happen? To keep us from drowning in financial jargon, we're going to stick to a really clear roadmap today. We'll hit 1, the core concept, 2, the product menu, 3, the market venues, 4, the key players, and finally, 5, the art of the trade. All right, Section 1, the core concept. Let's start with the absolute foundation here. What actually is a security? So the most crucial thing to grasp is that a security is really just a bridge. It's a legally recognized transferable contract. It lets an investor convert their savings into a financial asset that promises some kind of return. And on the flip side, it lets a borrower, like a giant corporation, raise the cash they need to expand. But the truly beautiful part here, the transferable bit. If you buy a long-term security, you're not locked in forever. No way. You can sell that claim to someone else literally whenever you want. Now, this flow of funds perfectly illustrates that exact bridge. You've got surplus income units, think everyday households or highly profitable businesses, and they funnel their extra funds straight to the deficit income units. They can do this directly through financial markets or indirectly through intermediaries like banks. And those deficit units? Those are the businesses and governments taking that money and actually putting it to productive use. It's basically the ultimate recycling of capital. Moving right along to Section 2, the product menu. Now that we know what a security actually is, let's explore the products you can buy and sell. Think of this as your personal investment menu, and you have a ton of choices depending on how much risk you're willing to take. You can go for equity ownership, where you actually own a fraction of a business and ride the wave of its growth. Or maybe you want something safer. You can opt for the steady, predictable income of debt instruments, things like bonds and debentures. There are also pooled vehicles like mutual funds and ETFs, and even physical commodities, think gold, silver, copper, that are standardized and traded right there on the exchanges. But honestly, what's truly fascinating here is that you don't always have to pick just one side of the coin. The market has engineered these really cool hybrid products. Take preference shares, for instance. They give you a fixed dividend, kind of like a bond, but they still represent equity. Or convertible debentures. These start off their life as a standard debt instrument paying you interest, but, and here's the kicker, they give you the option to convert them into actual equity shares later on. It's just a brilliant way to blend the safety of debt with the upside potential of equity. All right, Section 3. The market venues. We've got our products, so let's look at exactly where these assets are created and where they're traded. Now, this is an absolutely critical distinction, and it trips up a lot of people. The primary market is the factory where assets are literally born. It's where the issuer interacts directly with the investor to raise fresh, new capital. The secondary market, on the other hand, is the bustling highway where those already created assets just change hands between different investors. The original issuer doesn't see a single dime from those secondary market trades. The secondary market simply provides the liquidity that makes buying in the primary market attractive in the very first place. Let's break down 2 really common terms you're going to hear in that primary market. To use a quick metaphor, an initial public offer, or an IPO, is kind of like a store's grand opening to fund a brand new wing. The company's issuing fresh shares to raise fresh capital. But an offer for sale, an OFS, is completely different. Actually, think of an OFS simply as the current owners selling you their own keys. The existing shareholders are just cashing out. No new money is going into the company's actual growth. That brings us to Section 4, the key players. Let's meet the cast of characters who keep this whole financial metropolis running smoothly. Just look at the sheer scale of the ecosystem here. You've got massive institutional giants, foreign portfolio investors, mutual funds, sitting right alongside retail investors, which is just you and me. But connecting all of us is this absolutely critical infrastructure of intermediaries. We're talking the stock exchanges that provide the trading platforms, the depositories that securely hold our electronic shares, and the brokers who actually execute our orders. Now, if you're sitting there wondering why these intermediaries actually matter to your daily life, well, look no further than the clearing corporation. They are the ultimate safety net. In the secondary market, they provide something called full novation. What does that mean? It means they literally step right into the middle of every single trade. They literally become the buyer to every seller and the seller to every buyer. This guarantees the settlement of trades, and frankly, it prevents the entire market from collapsing like a house of cards if one random trader just defaults on their payment. And finally, Section 5, the art of the trade. Let's pull back the curtain and see how the actual transactions happen. Let's trace how a deal builds sequentially, right from a simple click on your screen to a finalized contract. First up is trading. That's where the formal agreement to buy or sell is actually struck. Next comes clearing, where the clearinghouse steps in and calculates exactly who owes what to whom. And finally, we hit settlement. This is the moment of truth. It's where the digital shares are actually delivered to the buyer's account and the hard cash is transferred over to the seller. Now, when we step into the world of derivatives, and remember, these are just contracts that derive their value from an underlying asset, you can make future deals in two main ways. You can use forward contracts. These are completely customized, one-on-one agreements made directly with another party over the counter. Or you can use futures contracts. These are highly standardized, strictly regulated, and traded safely on a public exchange. And then we have options. Options are a truly fascinating derivative. See, when you buy an option, you're paying a premium just for the choice to execute the trade at a later date. It gives you the right, but absolutely not the obligation to buy or sell. If the market suddenly moves against you, you just walk away. You limit your downside risk to just that initial premium you paid. You are, quite literally, buying financial flexibility. Swaps, on the other hand, might sound super complex when you read about them in the news, but the logic is actually pretty straightforward. They're basically just a clever way for massive institutions to trade their risk exposures. Say a company has a huge loan with a highly volatile floating interest rate. They can enter into a swap agreement with someone else to exchange those unpredictable floating payments for stable fixed payments. It's all about bringing predictability to their corporate balance sheets. Of course, understanding why people use these derivatives is just as important as knowing how they work. And it really comes down to two main motivations. You've got hedgers, who are in the market for insurance. They buy contracts specifically to offset potential losses on an asset they already own. And then you have speculators. Speculators are in the market chasing aggressive profits. They use those exact same contracts to make leveraged directional bets on where they think prices are heading. As we wrap up this explainer on the securities market blueprint, I want to leave you with a provocative thought straight from the NISM workbook. An investor looks for long-term fundamental value. A trader looks for short-term patterns to secure a spread. But a speculator, they take high-leverage directional bets based purely on expectations. So challenge your own financial identity for a second. Which one are you? Because knowing the difference is exactly how you protect your capital and ultimately find your true edge in the markets. Thanks so much for joining me on this explainer.